So we have talked about the unadjusted trial balance. The next step is the adjusting entries. So M, the notes payable requires the entire 30,000 in principal plus interest at 10% to be paid on January 1st, to be paid on July 31st, 2019. The date of the loan is August 1st, 2018. So if you still remember, this is actually a continuity of the previous transaction E. 30,000 is borrowed from a local bank and the note payable is signed. So what is the adjusting entry for this one? So now it is the end of August 2018. The date of the loan is August 1st. So this 30,000 is borrowed on August 1st. And now the note payable requires the entire 30,000 in principal plus interest to be paid on July 31st, 2019. So we're not paying this loan is associated with some interest, but we're not paying this interest yet. But however, we have used this loan for 1 month now. So interest has already occurred. So we need to debit interest expense and credit interest payable. And for how much? So the principal is 30,000 and 10% interest rate. And we have used it for 1 month. So that's 1/12 months, which is 250. The second one, assume that the company owns a machine that costs 18,000 and is expected to last 3 years with no salvage value. So here, the machine costs 18,000, expected to last 3 years. So this is, we need to record depreciation expense. Debit depreciation expense. Credit accumulated depreciation. So the machine is 80,000, no salvage value, and then divided by 12, multiplied by 3. Oh, sorry. So divided by 12, multiplied by 3. So which means that 3 years, and then each year we have 12 months. So this is the depreciation expense for each month, which is 500. The note receivable is dated August 16th, 2018. The note requires the entire 20,000 in principal plus interest at 12% to be repaid in 1 year. The loan was outstanding for 1/2 month during August. So this one is associated with the transaction. This transaction K, 20,000 cash is loaned to another firm, evidenced by note receivable. So here it is telling you that the note receivable is dated August 16th, 2018, and it's required. So until the end of August 2018, we have 1/2 month. The note required the entire 20,000 in principal plus interest at 12% to be repaid in 1 year. So the loan was outstanding for 1/2 month during August. So this is telling you again. So it is outstanding for half a month. So here, the firm hasn't received interest yet, but it is entitled to that half a month's interest at the end of August. So we can record interest receivable and credit interest revenue. And for how much? So the principal is 20,000, and then interest rate 12%. And then this 12% is for a year. So each month is 1/12. And now we have a half a month. So the interest is 100. The next one, the prepaid rent of 6,000 represent rent for the months of August and September. So here, this is associated with this transaction C. On the first day of August, 6,000 was prepaid. So now 1 month has passed. So we can recognize rent expense 3,000 because 6,000 is paid for 2 months. So each month is 3,000. And credit prepaid rent 3,000. So those are adjusting entries. And then we're going to continue to the next step. So after we made the adjusting entries, we need to post them we should post them to the T accounts. And then after we have posted them to the T accounts, we are going to have a new updated balance for those T accounts. So we take the updated balance for those T accounts, and after that, we are going to have a adjusted trial balance. So post adjusting entry to T account and prepare adjusted trial balance. And then I just omitting the step of posting again. You can do it on your own. It's very easy. And then I'm just going to give you the adjusted trial balance. So which is after posting those adjusting entries, some of the account balance needs to be updated. So we have accounts, debit, and credit. So cash. So prepaid rent now becomes 3,000 because in this adjusting entry, we decreased the prepaid rent by 3,000. So now the new balance becomes 3,000. And now we have a new account called interest receivable, which is 100. And we also have accumulated depreciation of 500. Account payable, 20,000. Interest payable, 250. Note payable, 30,000. So a lot of the accounts, like common stock, they don't change 50,000 because they are not affected by adjusting entry. Interest revenue 100. So if you calculate the total on debit side and the total on the credit side, they should be the same. So they should still be the same because the same as before, because even after those adjusting entries, for each of the adjusting entry, debit should be equal to the credit side. So even after posting those adjusting entries on your trial balance, the amount of the ending balance on the debit side should always be equal to the ending balance at the credit side.